Hello students, welcome to ixamBee. Please subscribe to our channel for regular updates. In today's lecture, we will be doing the accounts numericals for PFRDA and SEBI Grade A. The syllabus of paper 2 is given and we are focusing on commerce and accountancy. That is why we are taking accounts numerical in this particular lecture. As far as commerce and accountancy questions are concerned, this is quite an analysis of what all questions from conceptual and numerical concepts came in 2021, 2020 and 2022, phase 1 and 2. So we have to give a lot of importance on these topics, which is ESOPs, inventory, financial statement preparation, ratios, revenue, forex ratios. Ratios have already come a lot of times, depreciation. So we will be focusing on these questions more so that there is more chance for you to gain marks. So ixamBee helps you unfold your potential. So be with ixamBee. Let's start. The question number 1 is calculate the working capital of the company from the following information. Guys, what is working capital? It is the capital required for day-to-day working of the organization. The formula of working capital is current assets minus current liabilities. When we look at the components of the balance sheet which are given here, in the current assets we are given debtors, we are given cash, and we are also given current investments. In total, this adds up to 65 lakhs. And when we see when we look at the current liabilities, it is 20 lakhs. So 65 minus 20 lakhs, the answer should be 45 lakhs. Right? I hope that this is clear to everyone. Please pause the video to to calculate the answer on your own first and then verify it with the answers given. Second question is, a company's balance sheet shows 10% debentures of 5 crore and 2.5 crore at the end of financial year 21 and 22. So that means at the starting of the year, your opening liability in form of debentures was 5 crore. But at the end of this year, the balance sheet shows the closing debentures value of just 2.5 crores. That means 2.5 crore worth of debentures, face value worth of debentures are redeemed or repaid in this particular financial year, right? On the top of it, it is also given that the premium paid on redemption of the debentures in 22, that means in this year, was 25 lakh. Right? So what is the redemption amount? That will be shown in the funds flow or cash flow statement. Guys, see, funds flow and cash flow are different, but as far as the redemption amount is considered, it will be the same, right? So 2.5 crores is the face value that you have redeemed, but on the top of it, you have also paid a premium of 25 lakh, right? So that means in total, you have paid 2.75 crore to the debenture holders. So 2.75 crores is something that you've paid, and that is why it will be the redemption amount. So the balance sheet value is 2.5 crore which has been redeemed, but since the premium paid is also 0.25 crore or 25 lakh, the total outflow will be 2.75 crores. Coming on to the next question, Mr. Ankit received 1000 ESOPs at 50 each and the fair value of the shares is 120 at vesting time. What is the value of ESOPs for Mr. Ankit? Guys, what is value of ESOP? Value of ESOP is nothing but the fair value at the vesting time minus the price. Price of ESOP is 50. So the fair value is 120 at vesting time minus 50, which is 70 per ESOP. The number of ESOPs is 1000. So 70,000 is the correct answer. Please remember, it is fair value at the vesting time minus the cost of ESOP that the employee has to bear. So it is 70 per share for 1000. So it is 70,000. Next question, PLM Limited granted 1000 ESOPs to its employees on 1st April 2018 at 30. So the cost of ESOP for the employees is 30 and the market value is 90. That means the value of the ESOP is 60. 60 is the expense for the company and benefit for the employees. The vesting period is 2.5 years. If the shares are exercised after the vesting period, what is employee compensation expense to be recorded in the books of P&L in the financial year 18-19? So we have given the shares on 18, right? 2018. So the first year is 2018-19, second year is 19-20, and third year is 2021. Since it is having a vesting period of 2.5 years, so this is the first year, this is the second year, and in this year there will be 6 months, right? 2.5 years of vesting period. Now expense is 60. We write off the expense in this 2.5 years on a proportionate basis. So if 60 for 1000 ESOPs is the expense for 2.5 years, for the first year the expense would be of 12 months, right? So you have to, if you are doing it in months, so it will be 60,000 into 1 year has 12 months, and 2.5 year has 30 months, right? 2 years is 24 and half year is 6. So 30. You can do it like this, or you can also do it like 1 by 2.5. And if you solve this 60,000 divided by 2.5, you should be able to get the answer of 24,000. Since the vesting period is 2.5 years, the employee compensation will be written off over the period as 60,000 by 2.5, which is 24,000 per year. Next question is a bit simple. Here you have to tell the amount that will be contributing to the prime cost on account of direct material. We know that prime cost is nothing but the total of direct material, direct expenses and direct labor. Now the question is, they have given you information on direct material. They have given you opening stock, they have given you raw material purchase, and they have also given you closing stock. You have to tell the direct material cost that has been consumed to be added in the prime cost. So our opening stock is 600. You already had the stock worth 600 with you. In this year you purchased the stock worth 5,000. In total you had the stock of 5,600 to be consumed, but at the end of the year 7,000 worth of stock is not yet consumed. So it will be deducted from being an expense, and the expense will be 5,600 minus 700, which is 4,900. So 4,900 is the direct material consumed expense. So B is the correct answer. Next question. RCB Limited has to maintain a current ratio of 2 as per the loan covenant. So there is an instruction that it has to maintain a current ratio of 2:1. As the year approaches ending, its current assets are 20 lakhs. 20 lakhs in total, the current assets are 20 lakhs spread into 1 lakh of cash, 9 lakhs of debtors or accounts receivable, and 10 lakhs in inventory. And the current liabilities are 10,80,000, 10.8 lakhs, right? So you have to calculate current ratio. The formula is current assets upon current liabilities. Every one of us know. Current assets in total are 20 and current liabilities in total are 10.8 lakhs. So 20 upon 10.8 will give you an amount of 1.85. So 1.85 will be the current ratio. And what about quick ratio? We know that quick ratio is current assets minus inventory minus any prepaid assets. So here the quick assets are debtors and cash, which is 10 lakhs upon current liability. So the answer would be 10 upon 10.8 lakhs, which will give you 0.9259. So 0.93 is the answer for quick ratio. 0.93 is that current ratio, quick ratio is 0.93 times the current liabilities, right? Next question, if RCB, same question, it is the same question which is extended and said that it is selling, if it sells 2,50,000 worth of inventories on credit, what will be the new current ratio? So guys, when you sell 2,50,000 worth of inventory, your inventory, which is having original value of 10 lakh, will go down by 2.5 and the new value will be 7.5. How did I get the opening value? From here. So the opening value of cash is 1 lakh. The opening value of accounts receivable is 9 lakh and the opening value of inventory is 10 lakhs. You are selling 2,50,000 worth of inventory, so you'll deduct it here. Since you are selling it on credit, your debtors will go up. So here the amount of debtors will be reflected at 11.5 lakhs. Inventory will be 7.5 and the cash will be 1 lakh. In total, if you total it up, all the current assets, which is cash plus debtors plus inventory, you will be getting an amount of 20 lakh here as well. So 11.5 plus 7.5 is 19, right? And plus 1 lakh is 20. So the new current ratio will be the same, right? So there is no change in the current ratio, which is 20 lakh upon 10.8 lakhs. It is the same, but quick ratio will change. So if the question would be requiring you to calculate the new quick ratio, in that case, the cash is 1 lakh and debtors are 11.5 lakhs, right? Inventory we don't use. So this divided by 10.8, which is the current liabilities, will be the new quick ratio, which has gone up from the previous quick ratio, right? Next is our SP has the following information. You have to calculate the return on equity. What is the formula of return on equity, guys? It is the net profit available for equity shareholders divided by equity, the value of equity into 100. So in percentage terms, it is the value of return on equity. What are you given? The components given is PBT, pre-tax income, which is PBT. It is not PBIT, it is just pre-tax income. Had the question given you profit before interest and tax, only then we would have taken it as PBIT, okay? So PBT is 75,000. Your tax rate is 30%. So tax would be 30% of 75,000, which is how much? 22,500. So when you deduct tax, what will you get? PAT. So PAT will be, profit after tax will be 52,500. In 52,500, interest we will not be taking because it has already been deducted, right? Yes, so we need to take dividend paid to preference shareholders of 5,000. Then we will be left with 47,500 of profit available for equity. Net profit available for equity will be 47,500. Equity, we are having equity of 2,50,000 and multiplied by 100. So if we calculate this, we will be getting an answer of 19%. 19% is the correct answer for this particular question. If the question asked you to calculate PBIT, what would be that? In that case, it would be profit before tax is, we know that PBIT minus interest is PBT. So we are already given PBT of 75,000. Interest, we also know that it is 2,500. So in PBIT, you have deducted 7,500 to get 75,000. So sorry, 2,500 to get 75,000. So if I add 2,500 in 7,500, I'll be getting 77,500 as PBIT. So this is also something that you should able to calculate on your own. Okay, next question. You have to calculate the current ratio, interest coverage ratio and inventory turnover ratio from the information given in the table below. So current ratio we have calculated a lot of times. It is current assets upon current liabilities. Total current assets given to us as 1.5 lakhs and total current liabilities given to us as 1 lakh. So 1.5 is the 1.5 times is the current ratio. The next is interest coverage ratio. ICR, a very important ratio for solvency. Interest coverage ratio is formula is EBIT upon interest, the number of times profits are capable to cover the interest payments. So what is EBIT? Are we given EBIT? The answer is no. We are given net profit before tax. So we are given PBT. We are not given PBIT. So can we calculate interest? The answer is yes. Interest is, we are having a loan in the form of debentures of 2,50,000, which is having 13% interest. So 13% of 2,50,000 is the interest. So the interest amount would be 32,500. So since PBT is 3,61,000, PBIT must be 3,61,000 plus interest, which is 32,500. So ICR would be PBIT or EBIT, which is this numerator, and interest is 32,500. So the interest coverage ratio would become 3,61,000 plus 32,500, which is 3,93,500 divided by 32,500, which will give you the answer of 12.1 times. So in profits are 12.5 times the interest, which is a very good interest coverage ratio, right? So profits are capable of covering 12 times the interest payment. Next is inventory turnover ratio. The formula of it is COGS upon inventory. What is COGS? Here we are given that cost of revenue from operations is 7,25,000 and inventory is 1 lakh. So this, if you calculate this 725 upon 1, you will be getting the answer as 7.25 times is your inventory turnover ratio, right? So happy learning with ixamBee. Please subscribe to the channel for regular updates. Thank you.